I think last time we were together, you heard Bill Gurley and I say that risk premiums in the late-stage venture capital market were too low. People weren't demanding enough return at the valuations they were investing in. And so since we were here, a lot's changed. WeWork obviously was pulled, radical change in its valuation. We've seen the public markets pull back in terms of how they're treating money-losing businesses and demand that they perform before the value corrects. And so I think we've had a healthy reset of that late-stage market, but it's left the mid-stage and early stage largely unaffected in Silicon Valley.
You've had a front row seat, Dee,
yeah,
to the whole thing.
I started out the year by sitting down with Adam Newman and him telling me that they were ready for an IPO at any time. Now that we're at the end of this year, that definition of what it takes to be ready for an IPO has drastically changed. You saw Postmate ready. They were going to go. Now they've decided to delay those plans. I spoke to the Grab CEO and co-founder who said that they want to be profitable before they go public. You can imagine one of these gig economy platforms saying that they wanted to be profitable before they actually tap public markets. But that's what you're hearing now. And there's really that drive to show profitability and perhaps not strict profitability. It's always EBITDA or EBIT profitability. But I think that is certainly one of the biggest differences that I've seen throughout the year. It sounds
like, Brad, you're saying that the party's not necessarily over out here. It's just maybe the party's in a different place. The size of the party's a little bit different.
I know we always look for the headline as though Silicon Valley is a light switch on and off. Think of it more as a continuum. The late-stage market has indeed corrected. As Deirdre said, there's no room for money-losing businesses with no prospects of positive unit economics to get public.
Growth at any price is over.
Right? It's been reset. There's still stuff being done. There's structure on late-stage deals that are getting done. I don't think it's corrected as much as I suspected it might have.
Why do you think?
Rates are still very low. Tremendous amount of capital on the sidelines. Non-traditional players still investing in late stage, from foreign sovereign funds to family offices. And the NASDAQ's at an all-time high. Remember, the NASDAQ is still at or near that all-time high, which is attracting those late-stage dollars. And so WeWork sure was a shock to the system.
Was it as big a shock to the system as it should have been? I mean, the muscle memory here can be quite short, right? It wasn't too long ago that Travis Kalanick was pushed out of Uber, and then look at what happened to them in public markets. So I do wonder, Silicon Valley never took real ownership for WeWork because it's a New York-based company, and there wasn't a lot of venture capital relative to some other companies. So, Brad, do you think that the lesson has really been learned? Yes, you're seeing more money go into bigger companies with more distinct paths to profitability, but do you think this all just happens a few years
Well, I mean,
again?
Part of the health of the ecosystem, in order to be an investor in technology, you have to suspend disbelief sometimes. You have to believe that, that creative destruction will take out those businesses. I mean, it was just a few years ago. Remember, Groupon was the hottest late-stage deal that got done. Now where is it in the public markets? Zynga, late-stage deal. Now where is it in the public markets? And so those late-stage markets that we refer to as quasi-public markets, over $1 billion in valuation, have attracted a tremendous amount of capital from the mutual fund industry, from the sovereign wealth industry, in a way that's different. But I would say earlier stage venture is as healthy as I've ever seen it.
Are there other companies out here that you look at and say they're in the danger zone? Maybe not as drastic as a WeWork, but ones that are just spending a ton of money that need to maybe tighten their belts?
Right. Well, we're seeing belt tightening. I mean, Deirdre referenced Postmates. I think there was an article last week about them laying off employees, resetting the timing on their valuation. I suspect that all of those companies that compete with Uber or Lyft in the food delivery business, watching what has happened to Grub in the public markets, Grubhub going from $150 a share to $30 a share. Certainly, if you're DoorDash, if you're Rappi, if you're Swiggy, if you're Postmates, you're tightening your belts and you're realizing that the markets are going to be more demanding.